Sure.
I'd like to call this meeting to order. Please stand for the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, we have been notified by several members that they would not be able to make it tonight or will be arriving late, but if we go ahead with roll call, please.
Okay, Councilmember Jackson.
Here.
Councilmember Bozick.
Here.
Councilmember Rivas.
Here.
Councilmember Conover.
Present.
Councilmember Graham.
Here.
Councilmember Larson. Councilmember Witten. Commissioner Good. Commissioner Blaney. Commissioner Biggs.
Here.
Advisory Member Matt Besley.
Here.
Mark Risky.
Here.
And David Quinn.
Okay, very good, thank you. We do have a quorum, which is good news, of course. So welcome to the Porter County Foundation meeting, quarterly meeting update on our results. And before we get into the presentation from Capital Cities, can I have a motion for the approval of minutes, please?
So moved.
Second.
Motion on the floor and a second to approve the foundation minutes from our June 26, 2018 meeting. Any comments or any questions? Seeing none, all those in favor signify by saying aye.
Aye.
All those opposed? Motion carries. And then we will get right into our Capital Cities presentation.
Great, thank you. If you'll flip in your books there past the cover page, you can see our considerations and observations. It outlines kind of what we're going to discuss today in addition to the June 30, 2018 performance report. Amanda's going to go over a portfolio construction and spending analysis. It's the performance, the other one. Yeah.
Thank you.
She's going to cover a portfolio construction and spending analysis, and then I'm going to cover the report first. But just from an operational standpoint, as of June 30th, if you will see here in a second, the portfolio's allocation was getting a little bit out of balance, not outside the guidelines of the investment policy statement, but it was inching up toward kind of the limits for where we would rebalance. We worked with the folks up here in late August. We went ahead and rebalanced back to your strategic allocation, which gets you back within the risk tolerance guidelines that you indicated you wanted from the outset. Even though this is a June 30th report, we just wanted to make that note from an operational standpoint that did occur late last month. So if you'll flip past tab 1 and to page 1, we're covering the period ended June 30th, 2018. The bar charts there represent the returns in both the equity and fixed income markets for not only the quarter but the trailing 12 months. Kind of the turquoise bars are the quarterly returns, the gray bars are the trailing 12-month returns. You can see in covering equity, we had strong returns across all styles of domestic equity, which are represented by all of the bars save the two on the far right. Even though we had kind of our trade tensions with our trade partners, the returns were still strong. We had a strong earnings season, and we had positive economic data domestically, and you see that we had pretty good returns with the exception of kind of large cap value. They still had positive returns in large cap value, but they were slightly above 1%. Everything else did much better. Small cap value was kind of the leader in the equity space with a return of just over 8%. One thing I would note, the far left large cap core is effectively the S&P 500. We're in a momentum-driven market. If it wouldn't have been for Facebook, Amazon, Netflix, and Google, the S&P would have been negative. So those four stocks are really driving the returns in the marketplace. Going down to the bottom, in the fixed income space, we saw rates rise again, which has a negative impact for the most part on fixed income securities. You can see the third column over on the bottom, the Bloomberg Barclays Ag represents kind of the broad fixed income marketplace. It had a negative return slightly of about 16 basis points. The credit securities in the fixed income space were down almost 1%. So returns in the fixed income market were tough to come by. In both the kind of non-dollar and emerging market debt for fixed income, as well as kind of developed international and emerging market equity, you saw a weakening dollar and some weaker economic data affect returns in both those spaces. Probably important to note that the rates rose on the short end. It kind of flattened the yield curve, and the spread between the 2-year and the 10-year is at its lowest in 10 years at about 33 basis points. So it's even taking out some more interest rate risk or going longer on the yield curve, it just doesn't pay off right now. So you saw returns that were difficult to find in the markets for the quarter. On page 2, you ended the portfolio with a value of just under or just over $155.5 million. It was a 0.9% rate of return for the quarter. Your last 12 months has been around 5.6%. We really don't have much to talk about from a manager perspective. There is a yellow light, which on Diamond Hill.
We covered that before, though. All of the managers are exceeding expectations or, in line with expectations or doing better than their benchmarks. So despite the slightly more modest return of the quarter at only 90 basis points, that's more a factor of the market environment than a factor of your managers. Your managers are doing well relative to benchmarks. It's just been a really tough market. And with you having roughly 60% of your portfolio in fixed income, keep in mind that the broad fixed income market has actually been negative over the last quarter. So the fact that you're still in positive territory is quite a positive relative to the market.
And what I was referring to What I was referring to with regard to the strategic versus the actual, up there at the top, those two pie charts, the one on the left represents what the portfolio actually ended June 30th at from a percentage standpoint. So it was just slightly out of balance from your strategic allocation on the upper right, and that's why we did the rebalancing to get it back closer to the strategic. So that's really a quick thumbnail on the report, and we're going to go to...
Oh, I'm sorry. So that obviously making money in the equities, so we rebalanced and put more money back in where we were losing money?
That's rebalancing.
Which is required.
Yep, per your investment policy statement, you have an allocation on the top right of 40% equity, 60% fixed income, and you have a plus or minus 5% band to those. So you're getting really close to the 5% band. So it's our goal to keep you in line with your target, which is indicative of the risk tolerance that this committee established at the outset of these funds.
Well, we weren't there. Was it too early? I mean, you said we were getting close, but, I mean, the fact that we're making money in the one, I mean, is there...
Yeah.
Was that with your recommendation that we moved at that time?
It was, because it was 4 percentage points over. Your band is 5 percentage points. And the market, you've had a 1.75% positive return since the end of June. So that would have made it even closer to the 5%, and we saw that occurring. So we had additional data at our disposal at that time than just the June 30 numbers. We were looking at the August 15th numbers.
Thanks.
Yep.
Any other questions on the report? Okay, if you'll turn then past tab 2, Amanda is going to Go to
the
the
other-
next presentation.
Yep. Okay, thanks. So I will cover this relatively briefly. There aren't any recommendations from us for any changes to your portfolio. Nonetheless, the most important decision that you as fiduciaries can make over these assets is the asset allocation. That is, how much is in equity versus fixed income. So even when we're not coming to you with a change, we still think that it's appropriate for you to look at this at least on an annual basis and confirm that you're still comfortable with the allocation. So that's what this is designed to accomplish. If you'll please just look straight to page 4. When we take your asset allocation and we compare that to or include what the broad expectations are for returns in the market across different asset classes, we can come up with an expected return for your portfolio. Now, I think we all know better than to say it's going to return this or that in a given year, but still, we need to kind of, have a general idea looking ahead over the next 5 to 10 years, what might this portfolio return. So that's what you're seeing on page 4, with 30% in broad U.S. equity, 10% in global, and then the rest in fixed income. Your portfolio is expected to generally have a return of around 5%. These are the exact same expectations that we saw last year when we did this expectation, or when we went through this exercise. So there are no changes from last year to this year, and that is because, 1, your portfolio hasn't changed, and 2, the broad expectations for returns across the market have not changed. You can see that on page 5. We utilize Callen's return expectations. Callen puts out their thoughts on different asset classes on an annual basis. Other firms do it as well, like J.P. Morgan, Wells Fargo, et cetera. Callen's return expectations are always kind of right in the ballpark of those other firms, just kind of giving you some context. But you can see what Callen's return expectations have looked like over time. Certainly what we're all grappling with as institutional investors is that the returns just aren't there like they used to be 10, 20 years ago. You can see that on this chart. The far left of the chart is 1998. For instance, broad U.S. equity was expected to have a return of close to 10% in 1998. Today, that number is closer to 6.75%. Fixed income is even worse. Back in 1998, fixed income was expected to return over 7%. Today, it's at 3%. So those are the numbers that are going into your portfolio's expected return. So then when we look at, again, your asset allocation, it works out to be about 5%. On page 6, what's important for a foundation is that you think about your liabilities. So in this case, your liabilities are your spending policy. Well, the Porter County Foundation is really unique because your spending policy is determined by statutory code, by legislation. So you're not quite the same as other, community foundations or endowments where they can set their spending policy. Yours is a little bit different. It's set by statute. So we put in, the language here just for your reference. But when we think about your spending, what you need to consider is the impact of inflation. So what is your expected return? You take out inflation, and what that number is your equilibrium spending rate. That is, how much could you spend in a given year without eroding the corpus of these assets? So certainly with your portfolio at an expected return of 5%, the fact that your spending policy is kind of based on your earnings up to 5% helps. So you're not saying it's automatically 5% in a year. If that were the case, you would most likely be eroding the corpus of these assets over time. And that's something we would caution you against as an institutional investor and as a foundation that wants to be in existence for a long time. So your policy, though, has that flexibility built into it, and that's helpful. On page 7, we just want to give you a sense of what are other foundations doing. Again, you don't have a lot of flexibility to change your policy, but still we think it's worth knowing what other foundations are doing across the country. The average spending rate for public foundations is basically around 4.5%. That has certainly come down over the years in conjunction with return expectations coming down. On page 8, If you were to try to target a higher return in your portfolio, the only way to do that would be to take on more risk. So if you wanted to earn something higher than 5%, you have to invest more in equity, and that brings with it more risk. We're not advocating that. We're not recommending that. However, we wanted to just show you on paper what it could look like to increase the equity component of this portfolio. You could take it, if you took it up to just, again, solely for an illustration perspective here, take it up to 50% in equity, you would increase your return up to 5.4% on paper, as far as expectations go. But your risk, which is measured by standard deviation, goes up more. So your risk goes from 7.4% to 9.1%. So that's a mismatch. You're not getting much more in return, but you're taking on a lot more risk. Again, that's just indicative of the return environment that we're in, and we do not think this is advisable for you to consider, but we wanted to kind of show you an example. Any questions before I kind of move on?
Yeah, Scott McClure, are you here?
Present.
The statute, was it 55,
It is,
45,
and I think our current investment policy,
60, 40?
60/40. So I mean,
40/60.
yeah,
Oh, yeah.
Yes.
40% equities. We could have gone to 55, but we're at 40.
We're at 40% equities. And you recommend that, even looking out, that that's the proper place to be? I mean, if we could change that even slightly, try to gain more of the upside? I mean, because obviously what we just did was we just moved money from where we were making money to where we're losing money. I mean, if we had a
Which
little
is the idea behind rebalancing. You want to sell your winners and buy your losers, because you're buying your losers generally at a discount.
Yeah.
So,
I mean, at the end of the day, the question boils down to the amount of risk the foundation's willing to invoke. You have the statutory limit or the ceiling, which is sitting at 55% equity. When the investment policy was put together with Capital Cities and this board, everybody seemed to be comfortable at 40 and no more, and that's where it got stuck. What you're seeing now is the first rebalancing that we've had. But that's based upon the fact that in this current cycle that we're in, that the equities have done well enough to creep up over our threshold or get close enough to our threshold to require a rebalancing. But I think at the end of the day, it still is a much broader question of how much risk is the foundation willing to enter into to get to the returns that they're looking for. From what I've heard so far is that I think Capital Cities is trying to, as they've been quarterly, educate us on controlling our expectations as to what this foundation is going to be doing long term. And this is a glimpse, given our current landscape, of what that return will look like moving forward as best they can tell. And I think they've already said that they're well aware of our current construction of our portfolio and our investment policy, of whether or not I don't think at this point they're advising that we would move that equity level up, because at the end of the day, you are potentially gaining, and I don't want to speak for them, they could say it much more eloquently than I can. But at the end of the day, what you're doing is, to some extent, is it's easy to look backwards and see that if we would have been 15% more in equities, where we would be, but there are going to be cycles, and the reason why we're balanced the way we are is to keep so that we have some return, and our exposure to the risk is limited to a level that we can all handle as we move forward with basically taxpayer dollars.
As we can all remember, I mean, the intent initially was to take a very conservative approach to it. I mean, and handle that, handle that responsibility of protecting the corpus, very intentionally. And if we had a crystal ball, and if they or anyone could tell us exactly what's going to happen in the market, that'd be a wonderful thing. And then if it was positive for equities, we could throw up to whatever that maximum is. And if we didn't have the maximum, we could throw it all into equities. I mean, that would be that would be an option. Unfortunately, we don't have that crystal ball. We don't know exactly what's going to happen. We know in the last quarter, Dan shows up.
Good seeing you, buddy.
What do you think the future of fixed incomes? I mean, how do you see this playing out over the next 6 to 18 months or 24 months?
So, we have concerns about equity and fixed income, frankly. Within fixed income, certainly there's expectations for additional rate hikes. Those are largely priced into the market already. Nonetheless, that makes it very difficult to earn any more than 1% or 2%, if that, in fixed income. Nonetheless, when we worked through all of the asset allocation studies with this group in the initial weeks and months, we heard an overwhelming kind of conservatism coming from this group. One, because of the limits placed on you by your statutory code, but two, because of the newness of this and really wanting to protect these assets and do what's right. Because of that, you require a decent amount of fixed income to serve as a ballast. I mean, we're seeing equity valuations at all-time highs. That could just keep running, but if it doesn't, we do not feel like you're the type of group, as far as your risk tolerance, that could handle massively negative returns in a given year in this portfolio. So that's where your risk tolerance is driving your allocation. We can't let you use return needs to drive your allocation, or then we'll end up reaching for returns and exposing yourself unduly to the risk.
Especially with the volatility of the market. I mean, at that last meeting, we were right at the break of a day that was really, really bad and a day that was really, really good. And the last quarter, I mean, 90 basis points as a return, that's nothing to get unnecessarily excited about in a positive way. And so I think the conservative approach seems to make the most sense, because again, we are out, most importantly, to protect the assets and the corpus of the investment.
And since it's not our money, right?
Amen. Or if it was.
We'll also see a swing when fixed if equities drop. I mean, typical market.
Right. Then you'll see yields drop. In fixed income, you'll see prices go up, and just the opposite of what we've seen the last 2 quarters.
So we do have some sort of balance.
Yeah, and you've also, and I'll get to it here in a second, you've got a really good mix of investment managers that are approaching these things differently that helps as well. Was there a question over here?
What are we in our 3rd year going into our, are we in our 3rd year of
in the
investing?
3rd year, right? Or is it this, let's see. April 1st of 16
Of 16.
was the inception date of the investment portfolio.
And what amount did we initially invest in, the total amount?
131 million, approximately.
Okay, and our total today, the total foundation held in our portfolio is just
154.
155, 578.
Yeah, actually,
That includes some bonds being retired along the way?
as of a couple days ago, it was just over 158.
So we've done pretty well for ourselves up to this point.
Exceptional.
So,
Over 25 million in investment gains.
right. So I see little reason to get risky at this point.
Yeah, like we've said, we've built up a couple of good years of reserves to kind of get us through some, zero return years, or negative for that matter. So, yeah, I think we're going to be in pretty good shape to weather any dips in the market along the way, so long as they don't last forever.
Yeah.
Thank you. Okay, well, let's look at page 9. What you've heard us discuss mostly is the asset allocation, and that is the primary determinant of your risk and your volatility, but also your return. But we also want to make sure to touch on kind of the sub-asset class components in your portfolio and just remind you what you have in the portfolio. It's not just stocks and bonds, there are sub-styles. So, of course, you have a component of cash. Within equity, you have U.S. equity, you have a smaller amount to international equity. You have some passive management where you're just investing just in the market, things like the S&P 500, but you also have some active management. Those active managers have generally underperformed passive managers, but that often will flip-flop when markets change. When equity valuations fall, that's typically when you'd rather have an active manager choosing which stocks to buy and sell. So we think that over the long term, it still makes sense to have both of those in your portfolio. Within fixed income, you actually have three different styles. You have defensive fixed income, which is short-term, shorter maturity bonds, high-quality bonds. They earn a little bit more than cash, but those are certainly there to protect you in tough times. Then you've got a couple other broader styles of fixed income where your managers have more latitude to invest in the whole world of fixed income and try to earn more of a moderate return for you. So that's your portfolio. On page 10, I'm not going to go through this. I've actually kind of spoken to it somewhat already. But what we did on page 10 is go through each style in your portfolio. We talked about what happened over the last year, and we give you our thoughts looking ahead. The summary of this is that we're very comfortable with the mix of managers that you have. We're very happy with the diversification that's built into this portfolio. Just as an example, the fixed income market has been down. I mentioned that earlier. Over the last year, the broad fixed income market has been negative. Your managers have been positive. So we like the mix that we have in this portfolio. So finally, last couple pages here, on page 11, this is where we just would like to take the time to just summarize that the capital markets are unchanged from last year. We also do not see any fundamental change in the risk tolerance of this group. Therefore, our recommendation is to keep the portfolio intact as it is today, continue following your investment policy statement as it's written. We also are happy with the underlying managers. All of your managers are in good standing. Any questions on this page? Then we'll just leave you with our timeline on page 12. This is the fiduciary timeline of projects that we, as your co-fiduciary, help complete for you over the course of the year. Here, we're looking at the September. Sorry. My watch is going to help me with this part. Okay, so we're doing the portfolio construction here at this meeting. The next meeting in November or December, whenever it falls out, we will be doing an update to your investment policy statement. We view that to be more of a housekeeping update where we just kind of go through and update things in the appendix and things like that. We are not anticipating any type of overhaul, just a housekeeping type of updates. So that's our plan. Any questions for us?
I just want to add, since we're giving an update here on the overall performance of our investments, is to, speaking for myself, I think Capital Cities you've done a great job since you've taken this and managed it for us. All your information is very easy to read and to understand, and I appreciate that. It just wanted you to know that.
Thank you.
You're doing a good job.
Any other questions or comments for Capital Cities at this point?
So I wasn't here for that part of the meeting, but in comparison to other like in kind, if such a thing exists, peer group, we're doing pretty good.
The General Foundation peer group has a much higher allocation to equity.
Yes,
so there really isn't a great peer group. So instead of that, we think a better comparison is your target benchmark, your evaluation benchmark.
Mm-hmm.
And what that is we take your portfolio, 30% U.S. equity, 10%, so on, and then we sub out those components for market indices that match up to those styles.
Mm-hmm.
And then we say how would you be doing if you were just passively managing this and not even having active managers involved in doing all of these things? And when we look at that comparison, you're beating that benchmark pretty handily. I might just speak to it. It's on page 4 of your quarterly report.
Yep.
Since inception, your portfolio has had an average annual return of 7.1%. And that benchmark is 6.2.
Okay. That's just my question. Thank you.
And that's probably a reflection of what you all have recommended and how it's being managed and what our policy is asked you how to manage.
Mm-hmm. And a big component of your portfolio is passive in the equity space, so that part can't be the index. So that's your active managers are doing even better, if that makes sense, because you've got a part that's just going to be even. So it's a lot, the rest of the portfolio is working hard.
All good news.
Yeah, sounds good.
Any other questions at all? Mr. Vesely, Mr. Ritchie?
Thank you.
Okay, thanks so much.
Thank you.
Thank you very much.
A safe trip back.
Yes, safe travel.
It's been nice being up here with you guys. I miss that.
Jim, it was good having you. It's the good old days.
Okay,
You can stay.
and with that, we will move on to the attorney's report. We have nothing. Nothing to report?
They just
Nothing to
wanted
report.
to get up.
Okay, very good.
Thank you, Scott.
Any other matter that may properly come before the board? All right, motion to adjourn.
Well, I'll make that motion. Second.
All those in favor signify by saying aye.
Aye.
Our work here is done.
Meeting adjourned.